everyone, we just finished talking about current or short-term liabilities. Now the conversation obviously moves on to long-term liabilities. Well, what are long-term liabilities? Debt due in greater than a year. Okay, so remember we talked about this a little bit, but the idea is the balance sheet is segregated into short-term and long-term, right? Assets and liabilities. And the rationale there is if you are going to look at a business's current position, meaning do they have enough to pay their bills over the next year, then you're looking at things like current liabilities and current assets. But if you're looking to invest or loan a company money for a longer period of time and you want to know what the likelihood is that you'll get paid back, or if they're a good investment for the long haul, you'd be looking at long-term liabilities. Oh, so I clicked a little bit too fast. One of the first ones we're going to talk about are long-term notes payable. All right, these are typically installment notes, meaning the borrower makes equal payments and for the length of the note or for the length of the loan, and each one of those payments includes interest and principal. You know, so think about it like a mortgage or a car loan. If I'm not a lease, we're just paying part of it, but like a regular actual car loan. So when you're making those payments like a mortgage payment, you're not just paying interest, you're paying some interest, some principal with every single payment. Well, that's a typical long-term note payable. You can keep this note here for yourself for now, I'll illustrate it momentarily, but the idea is that the earlier payments in these types of things, in these types of loans, are traditionally interest at the beginning, very interest heavy, and then at the end of the life of the loan it tends to be very principal heavy, meaning if you take out a $10,000 loan, initially you're paying, when you make payments, it's going to be primarily interest, and only a little bit of principal. By the time the loan's at the end of its life, you're going to be paying primarily principal, and I'm going to show you why that is mathematically. Okay, and one, I thought I was out of order here. There you go. I forgot one up at the top. The idea is a long-term liability is often used to finance the operations of the business, right? If I wanted to take out, build a new building or expand operations, that's not going to be something done with short-term money, right? This is something done with longer term. So you're financing the operations of the business. That's typical long-term liability. All right, so let's get started looking at numbers with these for a long-term note payable. Here's the example, and I made this little A plus B equals C chart here. You'll see it as we go through why I did that. I just thought it was a little bit helpful for you to see how the columns played into each other. All right, so let's go to the problem. On January 1st, Lakeman Fay signed a $1.5 million 15-year 7% note. The loan required them to make annual payments on December 31st of $100,000 of principal plus interest. So let's start off at the very beginning. Let's borrow the money. Let's journalize the issuance of the note on January 1st. Well, what did Lakeman Fay get? They got cash, $1.5 million, and they now have a note payable. Okay, so I mean, that's the first entry. We're not dealing with interest or any of that kind of stuff initially. We're just borrowing the money. All right, let's take it a step further now. One other thing, sorry. I grabbed that 1.5 million and I put it into this little chart over here, this grid I made for you. The idea is as of January 1st, we have a $1.5 million loan. Now that's going to change as we go through this. It's 15 years. I only did a couple of years worth. All right. So now they tell us here that the payments are $100,000 of principal plus interest. So we already know how much of the principal is getting paid with each of these loans, with each of these payments. So it's 1.5 million now. You're going to pay 100,000 of that off, a principal payment, and we're going to get to the balance in a second, but the idea is that you've got $100,000 of this payment is going to be principal. We don't know what the total payment is yet, though, because we don't know how much the interest is. The way we're going to calculate that is we're going to take this 1.5 million. Remember, interest is calculated as principal times interest rate times time. Well, time is 1 year because these are only once-a-year payments. So you would take that 1.5 million of principal times the interest rate of 7%, and that's going to give you $105,000 of interest. Okay, so this full payment that you're going to make is going to be the principal of 100 plus 105,000 of interest, so your total payment's actually going to be $205,000. So that's why I have the A plus B equals C here for you, just so you can see the interplay. The balance now of that loan, because it was 1.5 million, but $100,000 of that payment was towards principal, so the new balance of the loan is $1.4 million. Okay, I hope that makes sense. Let's take it to the next year. Well, this is where it starts getting a little bit interesting. you still have a $100,000 payment towards principal because those were the terms of the loan. However, when you calculate interest now, you're calculating interest on the current balance of the loan. You now only owe these people $1.4 million. So $1.4 million at 7% is the new calculation. So your interest is now down to $98,000. Your total payment then is $198,000, principal and interest. And the balance of the loan now, it was $1.4 million less the $100,000 we just paid. You're at $1.3 million. Okay? One more year just to solidify this. So here's our next payment, $100,000. That doesn't change because that was what they told us. 7% interest on the new balance. The new balance of the loan is $1.3 million. So the interest piece is $91,000. That means your total payment's $191,000, and your new balance is $1.2 million. So you see obviously how this is going to go for the next 15 years. The idea is the interest is going to keep decreasing because the balance of the loan is going to keep decreasing. All right, so they're going to ask you next for the first note payment on December 31st, 2018. So I went further than I had to with this example, with this grid, but you can pick all the numbers you need right off of here. The idea is your entire payment, well, I'm taking it out of order. Your notes payable, you're reducing it by $100,000, right? Because it's a credit balance of $1.5 million and you're paying $100,000 towards principal, so you're bringing it down by $100,000. Your other piece is interest expense, right? That is the cost of borrowing the money. So you've got a debit because it's an expense of $105,000 and your credit is to cash, $205,000. All right, and for each one of these, you're just pretty much going to pick right off of here for each one of these types, for each one of these entries. So if they asked you for 12/31/19, you would grab these three numbers instead. Okay, so I hope you see that there's some principal, some interest. In this particular problem, what they tell us what they want the principal payment to be. They're not always going to tell us that. They might tell us something different. Instead, they might tell us the total payment. Now, if you see here, the total payment changes each year. Well, that's great because that's how this note is set up. But not all notes are set up this way. Think about, for example, we're going to go to the next one, a mortgage. If it's a mortgage, you can't have those fluctuations, right? People can't deal with that. Mortgages kind of need to be fixed. Well, I mean, not all mortgages are fixed, but people like mortgages to be fixed because you don't want a fluctuating payment, right? You don't want to owe, $2,000 one month and $1,000 the next month. You want it to be nice and even. You want to be able to plan your mortgage payments. So more often than not, you find out what the total payment is, and what you don't know is you don't know how that breaks out between interest and principal. Okay, so you can be told any of these pieces here. As long as we have two of the three, we can do the other part of this A, B, and C. And like I said, the A, B, and C here, we knew these two pieces, and we were able to back into the third. Well, now we're going to know the total payment and calculate the interest. The principal is going to be what we back into on this one. So as long as you have enough pieces of the puzzle to do the calculations, it will work, which, like I said, is normally two of the three pieces. All right, let me show you what I mean. All right, Ember Company purchased a building, market value of $280, land, market value of $55. On January 1st, 2018, Ember Company paid $15,000 cash and signed a 25-year, 12% mortgage payable for the balance. For the record, 12% is like crazy for a number, but we're going to go with it. Okay, so on January 1st, 2018, same as you did before, you're basically just buying the stuff and establishing the note or the mortgage payable. So we're going to record the building because that's what we got, and we're going to record the land that we purchased, and now we have mortgage payable for $320 of it and cash for $15 because we're paying $15,000 in cash. So all of these I just grabbed from this first sentence. All right, now mortgages typically you pay monthly, not once a year. Okay, so we're going to follow it along monthly. As of January 1st, 2018, we've got that $320,000 sitting there. That is the outstanding balance of our loan. So now let's look at this number. What they told us for this problem is they are telling us the monthly payment. Like I said, the monthly payment is fixed in this problem, whereas the last problem, the monthly payment fluctuated. So the monthly payment is $33.70. So we're going to put that in there, $33.70. That's your total payment, right? We didn't have that piece of information last time, so that's one of the pieces we're being given this time. The interest, well, the interest we're told what it is 12%. Well, it's going to be 12% of the $320,000. But we also have a time piece. So the principal is going to be $320. The interest is going to be 12%, the rate, but that's for a whole year because remember, interest is always stated as an annual figure. So we only want to be looking at 1 month of that. We want to look at 1/12 of that number. So what I did is I put the calculation over here. you've got the principal, $320 times 12% times time, 1 month. That puts you at $3,200 of interest. So we're going to grab that $3,200 and put it here. Now the idea is that you have the principal, you have the total payment. Of that $3,370 total payment, $3,200 is interest. That means the rest of it must be principal. That's why you have A minus B equals C up here. So you're paying $170 towards principal. The balance of the loan now is $320 minus the $170 principal payment. That puts you at $319,830. Let's look at the next month. Well, next month your interest is always being calculated off of the current balance, right? So $3,370 payment, that stays the same. But let's calculate the interest piece. The interest is $319,830, the current balance of the loan, times 12% times 112, which is $31.98. So our interest payment is $31.98. So of the $3,370 payment, $31.98 is interest. The principal then is $172. Not moving very much, I know. All right, so we take the balance minus the principal payment to come up with the new balance of the loan, $319,658. All right, let me get through the next two of these pretty quick because I'm running out of time. Same idea. All right, just to illustrate. Now what's happening here, well, let's do the journal entry and then I'll kind of explain the analysis of this in the next video. The journal entry, we're doing the same thing. We're picking the pieces right out of the grid. So January 31st, they want you to journalize the first payment. So we've got a debit to mortgage payable, right, because we're reducing the loan balance, $170 right there. We've got interest expense of $3,200 and a credit to cash of $3,370. All right, so what I'm showing you here, so now we will analyze this very briefly, is interest goes down every payment. And the reason the interest goes down is because you're always calculating off of a lower number, because as the principal goes down, the calculation goes down as well. The principal payment is going to come higher because you're going to be paying more towards principal with every payment as you pay less interest, because the $3,370 is fixed. All right, now you can see this over the life of any mortgage or any long-term loan. And I'm going to show you that in just a minute in the next video.